on the screen for now. While we've got some time, let's start addressing all your personal finance queries. Hemant Rustagi of Wiseinvest Advisors is our guest for the day. And the question for him today is, Hemant, it's generally believed that investors benefit from the systematic investment route or the SIP only when they, do it in equity or maybe even balanced funds. So generally, when someone wants to invest in equity funds, that's when they think of SIPs. Considering the fact that MFs actually have started offering a variety of debt funds as well, does it make sense for investors to use this SIP route even for debt MFs, and how does it compare versus investing in in your usual bank recurring deposit?
Well, you're absolutely right. I think most investors, when they invest through SIP, they opt for equity and balance fund. In fact, I would say over the last couple of years, even the gold funds have become a preferred option. But I think the reason why there has been focus on equity fund, balance fund is basically two reasons. One is that a systematic investment plan or a systematic investing or a disciplined approach is considered to be the best way to tackle the volatility that exists in the marketplace every now and then. And the second is all those investors who invest in equity as an asset class over the long term to achieve large targets that they have for these goals, opt for equity funds or equity-oriented funds. And because they do not have a lump sum to invest, they want to actually accumulate a corpus over a period of time, and that's why they opt for SIP. But if you really analyze their experiences from this, it has been actually a mixed experience, and the reason for that is that many investors start investing in these funds either without a defined time horizon or invest for a short term. And typically what happens is that every time the market goes down, we see a lot of investors stopping their SIP, and that I think is a clear indication that they do not really realize the fact that equity investment is for a long term and they need to continue. So I think the time has come for them to realize that the mutual funds offer much more than equity funds. There are a variety of debt funds which are available. There is ultra short-term debt fund, there is short-term debt fund, there is income fund, there are debt-oriented hybrid funds also. I think if investors need to really also understand that SIP is actually a mechanism that encourages investor to not only follow a disciplined approach, but also it inculcates regular saving habit. So therefore the fund selection clearly has to be dependent on the time horizon that investor has on hand, and also basically what is the objective that he wants to achieve. I believe that if you were to compare traditional options like recurring deposit with these short-term or ultra short-term or income funds, not only these options have potential to give better return, but also the returns are more tax efficient. Yes, in the traditional options you get guaranteed return, but normally the returns are low, and also because they're not tax efficient, you actually post-tax returns are very, very low. I mean, we can just understand by way of an example. If an investor in the highest tax bracket of 30% gets 9% from a recurring deposit, his post-tax return is going to be only 6.3. Whereas the same money if he gets in an ultra short-term fund, because the long-term capital gain is taxed at 10%, he will end up getting 8.10. And if he claims indexation, it will be even higher. So I think you can clearly see that if investors can move away from the fact that they want only guaranteed return, they actually can give themselves a chance to get better return and also more tax-efficient returns.
Okay, but in the specific issue, will an SIP only mean that it is a regular savings habit cultivation, or even in a debt fund, it makes sense? Is there any volatility at all that needs to be ironed out through SIPs?
Yeah, it depends, Lata. If someone is investing in, let's say, income fund, they tend to be a little more volatile as compared to ultra short-term and short-term. There, yes, the volatility will be there and you can benefit from averaging, but not so much what you see in, equity and balance fund. The point I'm trying to make here is that investors need to realize that one is SIP is meant for investors who want to accumulate a large sum over a period of time, and also the choice should depend on their time horizon and risk profile. What typically happens is that every investor, when they look at SIP, they want to invest in, in these funds, even if the investment has to be made for 1 or 2 years, which is not the right plan. That is why you see a lot of investors getting disappointed with the kind of result they get.
That point is taken. Hold on, Hemant, we have to take a break. We'll be back with more viewers who have questions on these issues. We were discussing in personal finance whether systematic investment should be resorted to only in equities. So clearly the advantage is more in equities, and gold perhaps where volatility is ironed out. More questions on that issue. Atiya Zaidi joins us from Delhi. Go ahead, Atiya. What's your question?
Hello.
Yeah.
My question is most of the time, I have been investing in FDs, and some mutual funds.
Okay.
But as I have not got much knowledge of the stock market, so I was just wondering, I have around 25,000 rupees per month. I wish to invest. So could you give me some plan on systematic investment or some other plans which would be of help to me?
Okay, but you have a decent number of mutual funds in your portfolio already, right? You have, what kind of mutual funds do you have at all?
I have...
all right, we'll come... Okay, unable to recall? That's all right. We'll have Hemant advise you on what questions you have already hurled at him. Go ahead, Hemant.
Yeah, I think in this case too, the most important thing to understand is that, systematic investment plan is a mechanism, is a way of how one can invest in different kind of funds. The key remains as to, what kind of fund one should be investing in. If the time horizon is slightly longer, maybe 5-7 years or even more, one can look at a mix of balanced fund and equity fund. And I think at this stage, I think the focus should be primarily on the fund that invests predominantly in large cap stocks, especially if the intent is to invest in equity funds. Some of the funds that can be considered are SDFC Top 200 and Reliance Top 200 or DSP BlackRock 100. One of these fund can be looked at. In the balanced fund category, one can be looked at SDFC Balance or Tata Balance. But if the intent is again to invest for the short term or not willing to take some risk, in spite of the fact that money will be invested through SIP, then as we discussed earlier, I think there is a need to then look at debt fund or debt-oriented hybrid funds. Maybe there you have an option of looking at short-term fund, which is Birla Dynamic Bond Fund can be looked at, and in the income fund category, SBI Dynamic Bond Fund can be looked at. So clearly, the important factor is to decide for what time period the money has to be invested, and let's not forget that even if one is investing for 10 years, the average holding period is going to be 5 years. So keep these two factors in mind and then decide the combination. That is when you can actually truly benefit from the systematic investing and also the potential of the asset class that you're investing in.
All right, Hemant, thanks so much for joining us. And Athiya, thanks so much for calling us. Just as we take a very short break, I think we've got the European market open.